I get questions from students in my courses, and Jorge is one of my students in my stock course, and he asked, he understood what stocks are, but what is a bond, and why might a bond be safer than a stock in a portfolio, particularly maybe if you're approaching retirement? So we're going to answer those questions today on Investing Education with me, Mr. B. Welcome to the channel where we help you to learn fast so you can become a confident and successful investor. That sounds interesting to you? Do consider subscribing. And check out the description below where we've got all sorts of free courses and other types of courses, full-length comprehensive courses that might be of interest to you. All right, so let's talk about bonds a little bit. What is a bond? How does it compare to stocks? And is it less risky? And is it good in a portfolio? Those kind of things. So let's start with some of the basics. I'm like, well, what is a bond? To help answer that question, I found this good article here, and I'll have the links and everything for the articles. I have a couple of other ones that I'll share with you. But they had a good image, and I wanted to share that image that really help us to walk through like what is a bond. So think of a bond as, as an investment that can give you income. Basically, it can give you money coming in. And kind of how it works is you are the bond investor, right? You are the investor. And let's say you want to buy a bond or a mutual fund of bonds or exchange traded funds. You can get bonds a variety of ways, but you want to invest basically $100 in bonds. And what you're actually doing is you're actually lending money. Here in this example, you use lending $100, for an example. But instead of like buying something like a stock and you're an owner, and we're going to look at the difference between stocks and bonds in a moment, but you're basically acting as a bank. You're actually going to give an entity some money. And they're going to give you something back in return. So if we walk through this graph, we're going to lend money, and bond issuers or people you're going to lend money to could be things like governments or companies, right? So if a company wants to raise money, they could, issue bonds, and then people are in effect lending the money to the company. Just like a bank would lend money, we are in effect lending companies money by buying their bonds. Or governments. Let's say the local government wants to build a new bridge or build a school or something like that, and they need to raise money beyond their tax revenue they have, they can issue bonds. And people like you and I can buy those bonds. Again, you can buy individual bonds, you could buy bonds through a mutual fund, or you could buy bonds through like an exchange traded fund. Ways to make it easier to buy bonds. So basically, we're going to lend this money, and we're going to give somebody money, we need something in return, right? What are we going to get in return? So what we get is at the end of the term, so like in this example, they're using a 5-year term. So I'm going to lend you my money for 5 years, $100 in this example, and you're going to have that money for 5 years. At the end of 5 years, I get back my principal. What I originally gave you, I get all that money back. So I'm going to give you $100, and you can use that I'll buy your bond, and you can use that for 5 years. Basically sit on my money for 5 years. And at the end, I get all that back. That's called bond maturing. Have you heard of like a bond that's maturing? That's what it is. You're getting your principal, the original, in this case, $100 investment back. But 5 years is a long time. Like, I don't want to just give you my money, and I should at least earn some interest on it. And that's true. You get interest when you buy bonds. So there's a cost to the entity, the government or the corporation, the organization, as far as not only getting your bond, but they also have to give you money, and that's the interest you get on bonds. So bonds are nice in that I can give this entity money, basically buying a bond. I get all my money back after the period of time. It could be 5 years, it could be 1 year, it could be 3 months, it could be 10 years. They have different types of bonds, sometimes known as treasury bills from like federal governments, for example, are also types of bonds. I get all my money back, and along the way, I get interest payments. Typically, those interest payments, by the way, are monthly, but they don't have to be, compared to like a stock dividend, which are typically quarterly. But again, it all depends on the term of the bond. So, but that's in essence, what is bonds? Right? You're basically being the bank, and you're investing in companies and in countries or federal or local organizations, and you're going to buy their bonds, and you'll get your money back. That's your principal, and you're going to get interest payments. So how does that compare to stocks? So let's look at a different article here that I have. Again, I'll have the links for you. And here we have a comparison of bonds versus stocks. If you see the word shares or equity, that means the same thing as stocks. And this is a pretty high level view. There's a lot more, there's different types of bonds, a lot more detail you could go into. But for now, we'll just kind of look at the big comparison between bonds and shares or stocks. So as you can see on the left-hand side, we talked about this, about what is a bond, right? Now, if we compare it to, let's say, stocks or shares, instead of lending money to, let's say, a company, they're using a company, a corporate bond that would be called, versus, let's say, a government bond. So a corporate bond, loaning to a company, In stock, you're buying shares in a company, and by buying shares, you're becoming a part owner in the company. Now, depending on how many shares you own, it shows you how much power you have in the company. If I have a few shares of Meta, which used to be called Facebook, as far as that, Mark Zuckerberg, the founder of Facebook, that later became Meta, has billions of dollars worth of shares. I have maybe a few, right? So I don't have as much power, but I'm still considered an owner versus like a bond. I'm considered more of a banker. Now, with shares, stocks, you expect to have growth in the share price and possibly dividends. They say dividends, but not every stock pays a dividend. So what do we mean by that? So if you buy a stock at price A, the whole idea is that you want that stock price to go up to B, and that difference when you sell is your profit, right? Your price appreciation. So that would be kind of like the principle of a bond where you can get that money back, but the idea is you're not only going to get your money back, because you're selling it at a higher price, you're actually going to make money on that, and you're going to get more than your principal back if the price goes up. Obviously, it could go down and you would lose money. But some stocks also pay dividends, which is kind of like the interest payments on bonds. Dividends are basically money the company is going to pay you, usually on a quarterly basis per share, just by owning the shares of stock. So if you want something in a stock market that's similar to a bond, look at like dividend stocks, for example. And then with both of them, there's no guarantee if the company goes bankrupt, for example, that you're going to get your money back. But bonds have a stronger guarantee, thus less risk, than stocks, as far as, there's really no guarantee around stocks. If a company could go bankrupt, you could lose all your money. If the company went bankrupt and you had bonds, you're at least higher up in the hierarchy of who gets paid first. Bondholders would get paid before stock shareholders, for example. And who gets paid first, by the way, overall, employees would be ahead of both of those, by the way. But who ultimately gets in first place on a bankruptcy? Curious thing. It's the lawyers. Lawyers, of course, they write these things. So if a lawyer's helping a company with, let's say, bankruptcy, they get paid first too. So where bonds come in is they're different than stocks. And then as we think a little bit further on this, and why, to answer Jorge's question a little bit more completely, why would somebody nearing retirement or want less risk in their portfolio be looking at bonds versus stocks? So bonds and stocks, they both can go up in price, they can go down in price. Things can affect their ability as far as their worth. Now, if you held a bond to maturity, you would get all your money back. But in the meantime, you can buy or sell that bond to somebody else, and the value of that bond, can fluctuate. A lot of it can depend on, like, say, interest rates. That can impact bond prices, for example. So the value of your bond can go down if you want to sell it before it matures. So, you have that risk there with bonds, but stocks, you have even more risk. And the other part of that, because the prices are changing dramatically every day, for example, or can be every day. But if we look at, let's say, bonds and stocks, bonds have a narrower range. Think of volatility or price changes, a narrower range of going up or going down based on what might be happening in the markets, interest rates, whatever. It has a narrower range than the stock market, which has much wider ranges of going up and down. So thus, especially over long periods of time, both can go up, or you can make money in both, but stocks have a better, overall return. Overall, historically, stocks return about 10%, bonds in the 5% range, but that can really vary depending, the current market situation you're in. So bonds are less volatile than stocks, less range going up and down, versus stocks have a wider range of going up and down. And thus, if you're nearing, let's say, retirement, as Jorge was asking, you don't want to start entering a retirement where something might have, even if bonds go down a little bit, you don't want to be like stocks where it's gone down a lot and you're having a hard time funding your lifestyle in retirement. And even though dividends can pay you some income, bonds are really designed to be income drivers. Most people buy bonds because they're really looking for that regular stream of income. So if you look at a diverse portfolio, for example, it's good to have a mixture of different asset classes. Not only bonds and stocks, you can have a little crypto in there too, some cash, some other types of things. Maybe you have some real estate, new things like NFTs, for example. All that makes your overall portfolio, and the amount of risk of your overall portfolio depends on the different types of investments that you have. So somebody who might be younger, not in retirement, or has a longer time horizon, might be real heavy in stocks versus, let's say, bonds. A classic portfolio might be 80% in stocks and 20% in bonds, as far as a classic growth-oriented longer-term portfolio, able to withstand those shocks up and down, because over time, stocks will rise over time that we see historically. If I'm a year or 6 months from retirement, I might not want to have 80% in there. I might want to have less. So those are things to consider. But the bottom line, bonds and stocks are both investments. You want to learn about both of them. I have courses and things around them. I have a nice investing for beginners course that goes into all variety of asset classes, including stocks and bonds, crypto. So it's a nice overview type course. So do check that out as well on the Investing Education with Mr. B website. So that's part of building your overall portfolio. All right, so there, you got a quick little look at bonds, where they fit, and hopefully you understand a little bit more. Check out the description for those links for the courses and also the articles. And so great to see you here, and I hope to see you in another video.